The relationship between the stock market and the bond market is a very, very interesting one. I guess the first thing to think about is what a rising bond market means to yields. So I want to go over all these relationships first before we take a look at this chart. First, bond prices and yields move inversely to one another. So when money is going into bonds, bond prices rise, but because they have a stated coupon rate, the actual yield that will actually present is on it continues to decline while bond prices are going up. Okay, now bond prices and stock prices also tend to move inversely to one another, because if you think about it, as the economy is strengthening, folks want to put money into stocks because stocks, as the economy strengthens, should increase their sales, increase their bottom line, thus driving their share prices higher and higher. When the stock market begins to slow down and it anticipates weakness, money is flowing into bonds. So money comes out of the stock market, goes into bonds when the economy is weakening, and then when the economy is strengthening, money will flow out of bonds and into the stock market. This is, by the way, this is a 5-year weekly chart. You can see the candlesticks represent the S&P 500, and then this line chart represents the yield on the 10-year Treasury. So that's the TNX at stockcharts.com. Now, the one thing you'll notice if you look at history, at least over the last decade or so, is that it appears like the bond market is leading the stock market by the nose. And what I mean by that is that we seem to get a move in the bond market before we get moves in the stock market. So if you're trading stocks, that can be a very, very valuable piece of information. Now, if you recall, bonds and the yield move inversely to one another. Bonds and stocks move inversely to one another. So that means that stocks and the yield move basically in the same direction. And you'll see from this chart over the last 5 years that generally when the S&P 500 is going down, the yield on the 10-year Treasury is going down. And then when we start moving up, they both tend to move up together. And then when they start to come down, they start to come down together again. But one thing really stands out to me, and that is many times you're going to get an advanced warning. If you're following the yield, many times as the S&P 500 keeps moving in one direction, the yield will begin moving in the opposite direction, giving us a little bit of a heads-up clue that maybe the S&P 500 move is just a head fake to the upside. Let's take a look at a couple of these examples here. Back in 2007, if you remember, the S&P 500 topped. It was October of 2007 that we put in that top. That we have not gone back and tested again. When we were doing that and moving up to those new highs, look at what happened to the 10-year Treasury yield. We had dropped from about almost 520, maybe 510, to about maybe 470. So about a 50 basis point drop in the yield while the S&P was trying to put in a new high. Now again, what does this yield drop mean? It means that money is flowing into bonds. Why would folks be buying bonds? Well, because they anticipate that the economy is slowing. But why, if the economy is slowing, would the S&P 500 be breaking out to new highs? Well, it shouldn't, and that's your that's your warning sign. So you've got to kind of look at this in terms of these two kind of running hand in hand, the S&P and the 10-year Treasury yield. And when you start to see these types of divergences, where the S&P 500 moves from one price level to a higher price level, and you've got the 10-year Treasury yield not following suit, you have to at least begin thinking that this is a heads up or a little bit of an advanced warning of some potential weakness in the S&P 500 to come. Take a look. The yield continued falling, and it wasn't long before the S&P 500 followed suit right down through the bottom in 2009. Now, what happened at the end of 2009, or at the end of this downtrend, I should say, in March of 2009 is very interesting, because we had the exact opposite thing occur. The S&P 500 kept going lower, but notice the yield on the 10-year Treasury bottomed at the end of 2008 in December. And as the S&P 500 moved to new lows and printed new lows in March of 2009, take a look at where we were on the yield. Much, much higher. The yield had risen from 210 up to about 260, 265, even though the S&P 500 had printed new lows from the 800 level down to 666. So this bottom in the S&P 500 was actually foreshadowed by a move higher in the yields. Bonds were being sold in anticipation of a strengthening economy, but the S&P 500 was not reflecting that. It continued to move lower. This was a positive type of divergence, where the S&P 500 moved from a low in November of 2008 to a lower low in March of 2009, and during that exact same period, we saw the yields bottom in December of 2008, and we're nowhere near those lows in March of 2009 when the S&P 500 was making that new low. So very, very interesting development. And once again, the strength in the yield, or the weakness in the bond market, however you want to look at it, foreshadowed this rally in the S&P 500. Now, you don't know exactly how far it's going to go, but the bottom line is it was giving us directional clues. And as a trader, that is important, very, very important, to know or to have a good idea, a sense of which direction the market's going to go. Obviously, if you know the market's going to go up, or you have a good feeling it's going to go up, it's going to increase your opportunities for positive trades on the long side, and should start warning you about playing any additional shorts. Now, notice what happened. These the yield and the S&P 500 kind of went hand in hand. They both were rising throughout most of 2009, but then as the market, the S&P 500, the stock market, put in a new high in April, May 2010, notice that the yield kind of topped right in here at about the 380, 390 area. That was interesting because after a slight pullback, you can see the yield start dropping. After a pullback, the S&P 500 went up to another high and put in higher highs. But at the same time, even though the yield started rallying, we never got back to those prior highs. So we had 3 or 4 tops right at about the 380, 390 level. And then as the S&P 500 was breaking out again in April and May of 2011, we saw the 10-year Treasury yield actually rising, but only coming back up to about 360, nowhere near that 380 to 390 level that we had seen a year earlier. So once again, the signal here was that the yield was not getting back to where it was before. It hadn't risen as much, and as a result, the actual bond prices themselves were coming down, but did not set new lows, just like the yield did not set new highs. So the bond market was at this point suggesting that maybe prices, that the economy was weakening, and that the S&P 500 would maybe be set up for a tumble to the downside. And lo and behold, as we moved into the summer months, that's exactly what we saw. Now again, this is just one indicator, and we're continuing to go through all of these different indicators, but this is just one indicator, and we need to take this this indicator in concert with all of the other indicators that we look at, and we try to figure out from a puzzle perspective, do we have enough pieces that fit to suggest that the market's going to head in one direction or the other. But the bottom line here is, when you're looking at the 10-year Treasury yield and you're looking at the S&P 500, look for clues where the S&P 500 seems to be acting on its own, heading in one direction or the other, while the yield or the bond market is telling us a completely different story.